All right, so right now we're looking at this trend where central banks are buying a lot of gold, but at the same time, we've seen gold pull back very sharply from its all-time high that it hit just a few days ago. Now it's back below 4,000. Is this a buying opportunity?
We do think it's a buying opportunity. And while we may still have some downside from here, one of the key takeaways is that, all of the major drivers, I think, of gold's rally that we've seen year to date, it's hit at least 48 all-time highs just in this year alone. All of those drivers that got us to those levels are still intact. It's natural for an asset like gold to pull back after hitting such all-time highs. And we do think we're getting much closer to more attractive entry points from here.
All right, so you say all the fundamentals are intact, but just earlier this morning, we heard from BlackRock's Larry Fink. He's over in Riyadh. He's saying that most major investors, they're overweight U.S. equities. Do you think that also kind of leads us to U.S. treasuries as well? Do you see kind of a reversal of these central banks going from buying so much gold to buying more treasuries?
Well, we think that the broader theme of central banks moving into gold more sustainably is still intact. Central banks for a number of years, you mentioned it before, have been buying gold in significant size. We saw official sector holdings rise by over 1,000 tons in each of the last 3 years. And this year we expect to be another strong year, even if it's not at those levels. The reasoning largely has been around de-dollarization and diversification, but we'd also add geopolitics to the mix, especially this year. So we see central banks continuing their interest. We see investors who have continued to accumulate gold. Obviously, we've seen some sales most recently with this sell-off we've seen from all-time highs. However, these investor exposures, the central bank exposures, as well as the broader macroeconomic backdrop is all favoring gold. When we're looking at, higher equity and bond correlations, gold really stands out as a diversifier. And based on our conversations with investors, we've really seen that interest in gold rise this year.
All right. Gold is surged past even your base case price target of 42.27. Obviously, again, it's pulled back quite a bit. Is there any thought that gold may be in a bubble? It's kind of moving higher on a lot of uncertainty, a lot of trade tensions and things like that. And if those things get settled, does that mean gold automatically moves back lower? Or do you think the trend of central banks buying is maintained?
I think we've already seen the quote unquote bubble sort of burst, particularly coming from all-time highs, now back below $4,000 per ounce. Again, I think a good entry point in our view. Our low scenario price target is 36.11 per ounce on average for Q4. And so you can get the sense that we think around here, maybe slightly lower, will prove a pretty attractive entry point for gold over the long term. Generally, the reason why gold has been so attractive this year, you mentioned it, geopolitics, all these different types of uncertainty. At some points, it's been about trade uncertainty. At some points, it's been about geopolitics. At some points, it's been about armed conflict. At some points, it's been about questions about the Fed's independence. If we've learned anything this year, it's that uncertainty can come from a number of different places. And we think that will continue to unfold, not just through the end of this year, but also to 2026 and potentially beyond, which is where we think gold can continue to grow and can get back to that $4,500 per ounce or $5,000 per ounce. These prices a few years ago didn't really seem possible, but at this current price level, in this environment, we think it's certainly potential for gold to trade higher.